Good afternoon. My name is Ala McCoy. I'm Director of Startup Support at the University of Maryland's UM Ventures. And I'd like to extend a very warm welcome to all of you who joined us today for the next installment in Startup Fundamentals Workshop Series. Both live webinar audience and those watching a recorded version on our Startup EMD YouTube channel. This workshop series is offered by UM Ventures in collaboration from MTech at the Clark School of Engineering and Dingman Center for Entrepreneurship at the Smith School of Business. To everyone attending the live session, please feel free to submit questions using the Q&A function. You should be able to find it at the bottom of your screen. We are recording the session, so it will be posted on our Startup PMD YouTube channel. So you may submit your questions anonymously if you would like to remain anonymous. At the end of the session, I will also be able to unmute your microphone. There's a button there that you should be able to see. It says raise your hand. So if you can raise your hand, I can then unmute you to indicate that you would like to talk. I can unmute your mic, but again, remember that we are posting this on YouTube. So thank you so much. And I'd like to welcome our speaker today, Sam Handberger. Sam is a lecturer at the Robert H. Smith School of Business here at the University of Maryland. He's also a patent practitioner, tax practitioner. Different workshop. Sam is a very experienced tax practitioner, accounting practitioner, and does a lot of help specifically for startups and startup businesses. So thank you so much, Sam. So today's session is going to be a webinar. We are also planning a live session in person sometime in January where you will be able to come in and have free flow and Q&A sessions. So stay tuned for that. So thank you so much, Sam. I'm going to hand the microphone to you. I'm going to monitor the Q&A and chat. And I'll help with the Q&A, but the floor is all yours. Again, thank you so much for covering the very important topic of R&D tax credit for us. Very super important for startups.
Thank you very much for having me here again. We are going to be talking, as you said, about the research and development tax credit. That's what the R&D stands for. And it has a unique importance in the tax world for startup businesses and businesses of all sizes and all stages of development, whether they're new or old. Basically, the research and development tax credit is a way to incentivize companies to do research and development. So we're going to have to define what that is, and it gives a certain tax benefit from it. Now, if you're thinking, well, I'm not doing research and development, stay tuned. You may be surprised to find out what you're going to see here today. And number two, if you're thinking about, well, is this going to help attract investors? And the answer is it can. It definitely can. Investors who have passive activity income can use the tax credits to their advantage that would flow from your startup business or your ongoing business. So that is an incentive for you to think about if it applies to you that, and you're saying, well, I don't need the tax credits myself. Could be you can attract money to your entity. There is recently, we're going to see this in detail, but I want to just get your excitement wet, your adrenaline going. There is an additional benefit with the research and development tax credit that came about starting in 2015, which for startup business is a really cool idea, particularly if you think of yourself in the technology world and you're doing development with, say, software or an application or whatever it is might be that's applying on a computer today or in any technological way where you're incurring lots of payroll costs in order to enhance and do the development. Your software engineers, as an example. So this particular part of the R&D credit can help reduce your payroll costs. And that is a big benefit, even without attracting investors, if you can reduce the actual cost of the payroll. And that's what we're going to see in a little while. Okay, so now we're going to go to screen so we can start the formalities of the actual presentation itself. And we're going to jump right in. Here we go. Okie dokie. Move that out of the way. And we will begin talking about the R&D tax credit overview. One of the things that always needs to be done the first time around is to understand what's the difference between a tax deduction and a tax credit. So I'm going to give you a lesson on both of them today, and we'll see how these play in so you can understand why the word credit in research and development, tax credit, is the important word. All right, so we're going to talk about C corporations versus pass-through corporations. Most of you who are in a startup mode fall into this category. You're either a sole proprietorship, so the net income of the business passes through to your individual return, and that's where you pay tax. Some of you may actually wind up being C corporations. This is a tax-paying entity. It pays taxes on its own. Whereas the entities here, which includes LLCs and partnerships, limited liability companies and partnerships, and many of you are limited liability companies, these do not pay tax. The tax is passed through, the income or the loss is passed through to the owner, and that's where the tax is paid. So that's one foundational concept that needs to be understood, is that there are tax-paying entities, those are known as C corporations, and then everything else would be something that falls on the individual return. And then we're going to talk about the difference between the tax credit versus the deduction. So let's take a look at numbers. Okay, well, that's it's inevitable in a course on taxation, I think. So let's take a look at an example. This would be the C corporations that we mentioned. These are tax-paying entities. Let's see what happens here. We'll just go through quickly. It has revenue, has expenses, and those expenses, which are done through accounting procedures as allowed by tax law, get you to total income, and then you have other expenses. And you can see what these other expenses do. They're deductions. These expenses reduce the total income down to, at the end of the day, a taxable income of $500,000. And that's where we apply the tax rate, as you'll see right up there. There we go. That's where the tax rate is applied. And it's on that particular portion, that number is how we determine how much tax to pay. So we get our taxable income, we bring it up there. As you can see, the rate for C corporations today is a flat 21%. In the President-elect Trump campaign, he has made the mention that he might reduce the tax for C corporations down to 15%. That would be a big game changer. The rate here was at 1.37%, so already we are at or 35%. It was at 35% there. So by the reduction to 21%, we are already at a new place in the history of C corporation taxation in America. Going with the math, we get a total tax of 105 based on 21% of the 500,000. If payments had been made, let's say through withholding taxes or estimated tax payments, that would have been reducing the total tax owed when the tax return is prepared. So when the tax return is prepared, if there's a tax computed here, any taxes already paid would reduce that to a total tax due of $30,000. And that's a basic formula for C corporation tax. And now you can do tax returns. Well, maybe not. Okay. Pass-through entities. Same idea in terms of the numbers, meaning we still get to a bottom line of business income, but this is no longer taxable income at this point, because for these entities, which are called C corporations and partnerships and LLCs included in this category, and sole proprietorship. So if this is you as a sole proprietor, then it would be the same thing. And the result is that we're going to now figure out what's the tax effect on the individual return. So let's go up and say, this is the tax return, not for the entity, it's for you, the individual, or your partners. And what you'll be doing is you'll be taking a look at, on your return, what wages you may have had either from this business or from another business, another source, plus the ordinary business income, OBI, is going to be added into your individual return. So now you're going to pay tax on $600,000 because that represents all of your income from the year. It's the wages that you made, 100,000 plus the income coming from your pass-through entity that you are either a partner or a member or a shareholder of. Then you got the standard deduction. That number's probably gone up, so it's a little higher. And you get a taxable income. And it's times whatever rate you're in, and we'll just call this an effective tax rate. The individual rates are on a graduated scale. That means the higher amount of income you make, the greater percentage you pay on the last dollars going into that income. So when the first dollars you pay 10% and then 15% and then 22% and so on up to a maximum of 37% today. The maximum today is 37%. So after like, I don't know, like $1 million maybe, something like that, you have to look at the tax brackets and you can see where the 37% rate kicks in. At that point, regardless of exactly how you get to the actual tax computation of this number, the tax that is the liability, that's your tax for the year, you got the same thing as with C corporations. You may have paid in through withholding tax or estimated tax payments a certain amount, and you're left with a balance due in this example. Now let's take a look at the credit versus deduction so you get an idea of what this is. First of all, the concept is a tax credit is dollar for dollar reduction of your taxable income tax, not your taxable income where you're going to apply the rate, but it's a dollar for dollar reduction of a taxpayer's income tax. So the two words go together, not the taxable income. It's not a tax deduction. Let's see what the difference looks like. Here's the scenario. On one side, we've got a deduction, and the other side, we've got a credit. We're going to say the two amounts are the same, $100,000 deduction versus a $100,000 credit. And I'm going to prove to you that the credit is most of the time, like 99% of the time, more valuable. So here's a deduction of 100,000. Yay, deduction of, we say yay because if you're going to reduce your tax, yay, deduction of 100. So your taxable income goes from 1 million down to 900. Apply the rate at the corporate level. Let's pretend we're at the corporate level, and you get and there's no credits. There's no credits, and you wind up with a tax of $189,000 due. All right, that's one scenario. Second scenario, the credit, $1 million on the side of the income. No deductions. Oh, bad. That's not so great. So you got $1 million taxable income at 21%. It's 210. But now the 100,000, not a deduction, is a credit. And look at the difference. It's a dollar for dollar reduction of the tax. And that's why credits are, when you see the word credit in the tax code, it's very valuable. Deductions are only as good as the tax rate that you're at, whereas tax credits are just dollar for dollar, take it off the top. The research and development tax credit. Let's take a look at how this developed. It's designed, and it still is, to be an incentive to provide cash through the use of tax credits for conducting research and development in the United States, and that's a crucial point to make right there. So we're talking about research done here, not in a foreign country. It's claimed on your tax return. It offsets the dollar for dollar, as we learned. It's not a tax deduction. Okay. I'm not going to overwhelm you with code sections, but in case you want to impress your friends and relatives later, you can throw out the section 41 is where the research and development tax credit comes from. It started as an economic recovery tax act in order to boost the economy, and it was expected to be a short-term venture because it was only to boost the economy based on, at the end of 1981, we have a whole bunch of recession years. So the idea was, let's just jumpstart the economy and get things rolling. However, it became so popular, both within the business community and the politicians, it's been extended 16 times. So initially it was just for a short period of time to help the economy, but it's done so well in stimulating research and development in the United States that it got extended, and now it's permanent as of 2015. So now you can rest assured that you don't have to worry about it going away through it only being an expiration date. You can't rest assured that Congress won't undo it, but you can rest assured that at least in the code section itself, it's expected to be there. It's incremental. We'll see what that means, but it's not going to be terribly crucial that it is, but we'll see about it. And this is what incremental means, basically. So now you're there. It's called in the tax code the credit for increasing research activities. And the concept is that this year, so we'll call it 2024, the R&D work, whatever that is, and we will define it, is greater than in prior years. That's the idea. Now, you might say, well, then that means at some point in time, if I don't keep increasing my research and development activities, I'm going to wind up not being able to utilize the credit. And I can't say nothing can be further from the truth, but it's almost true because what they do is the prior years are averaged. They're averaged, and even better, they're at 50%. So you wind up having a situation where if you have a continuing, even level amount of research and development without an increasing amount, you'll still be available. You'll still be able to make availability of the credit in the future years. It's not a terribly, it's not restrictive to you really have to increase. Of course, if you do increase by a lot, that could be great. And if you decrease, so you go significantly down from your prior research and development, then the credit may be not available to you. All right. And this is what I want to really concentrate on. I'm not going to spend a lot of time on it, but I want you to really concentrate, and we'll go over some of these things again and again for emphasis. But this is why I said in the beginning, don't think that research and development doesn't sound like you, so it doesn't apply to you, the research and development tax credit. Look at what you don't need. You don't need a laboratory. You don't need scientists or engineers on staff. You don't need to be inventing new or improved technologies. Wow. So the world looks like it's more wide open than you might expect, and it is. And you don't have to have increased activity over last year to get the credits this year because of that, taking the average times 50% of the prior year amount. So you can wind up with steady amounts of research and development activities year after year. So just a quick aside, to relax your brain for a minute. We're not going to go through this, but what's happened in my life as an accountant is, although I'm getting fairly old, that they have not stopped trying to teach the old dog new tricks, and I'm doing forensic accounting more so than I've ever done in my career. And timelines, which is a staple of forensic accounting. So I included a timeline, but we don't have to spend too much time on it because it's not really that relevant. All right. What is relevant is that for the credit under Section 41, you have to have Section 174 expenses, known as research and experimental expenses or expenditures. And Section 41 modifies them somewhat, but mostly the definition of what research and development is, or research and experiment, comes from Section 174. So we're going to spend time to understand what 174 says in terms of what they are. All right, so let's go forward. We can come back to that later. So let's skip that for now. If we have time, we'll come back to that. That's not relevant to the research and development tax credit. What is relevant is that we have the expenses that qualify under Section 174. All right, so you have profitable businesses that can make use of the credits to offset their income tax. And this is that new one I was talking about. So let's spend a moment here and just digest what this has to say. If your business is a real startup, in other words, you're a qualified small business, what does that mean? Here's the definition of qualified small business. You've had gross receipts in the current year of less than 5 million, meaning your sales are less than 5 million, and you didn't have any gross receipts in the prior 5 years to the year that you're talking about, then you can begin to use a qualified small business research and development tax credit, and this number's changed to 500,000 to offset payroll taxes, which reduces the cost of your employees. That's what we were saying before. If you have a startup business that needs to do a lot of development work using software engineers or people who are development type trained engineering people or otherwise, in the science field, then this is a way to fund that by being able to take it off the actual payment, even if you have zero taxes. So you might have zero income tax, but you got a lot of payroll. Now you can help fund your payroll with a tax credit against the cost of the payroll taxes themselves. It's not the payroll, but the payroll taxes, which is still not an insignificant amount, potentially. Just to give you the heads up on the rules, gross receipts for 5 or few years, have gross receipts for 5 years or fewer, meaning you've been in business making sales for 5 or fewer years. So you might have been in business, I guess you could say, from 2010 to 2015 with 0 sales. And then you start in 2016 and you get up to 2020. You're still good for this credit if it's less than in 21, $5 million in sales for that year. Of course, you have to have payroll taxes in order to apply the credit against. In the event that you don't, you can carry those forward. So against future payroll, so all is not lost. Even if you don't have payroll tax liability in the year you take the credit, you can carry it forward. I believe, you can quote me on this, you can carry it forward 20 years. So a really powerful way, if you're going to have significant payroll costs, or reducing that cost, and maybe we should just stop here a second before we go to the next step of further defining what are research and development expenditures. How we doing, Ala? Good?
Yeah, we're doing good. I don't see any questions. But if anybody does have questions, please pop them in either in the chat or in a Q&A function.
Okay, excellent. All right, that's good to give our minds just a little bit of a 10, 15, 20-second break and then reset, because we're now going to go into something new. Same thing, but now we're going to talk about what are the expenditures or what qualifies for research and development. This is more about what qualifies. The expenditures are coming next, but this is the issue. There's a 4-part test to know whether you're doing research and development. We'll take a look at the broad strokes here and then dive in a little bit more into the woods. New or improved business component. You're looking at something that you're going to do, and you're going to do it a little bit better, or it's brand new. It's a business activity is what we're looking at. Something better. It could be, and it could be computer work, by the way, too. Easily, that's one of the ways a lot of companies fit into the research and development tax credit. They're improving some software, which is a business component. There is an elimination of uncertainty, because whatever you're trying to do here has an uncertainty. How to do it. The client that I have had use the research and development credit is in the retail business of selling furniture. So what the heck? How in the world are they having research and development? So what it is that they've been improving their point of sale software that they developed in-house. They've been improving it so that it is more user-friendly to the outside world, and of course inside the office as well. It's user-friendly, it's more accurate, gives more timely information, ability for the customers to do more faster than they ever were before. So they can order furniture, they can pinpoint the exact, imagine this, if you've ever had furniture delivered, imagine being able to be home between the hours of being told you have to be home between the hours of 9 in the morning till 5 o'clock in the afternoon to receive the furniture. And you're saying, well, I got to go to work. And they're saying, well, you got to be home those hours. So today in the remote business world, it's not so terrible, but you've probably experienced that concept of they give you this wide range. Imagine, and this is what they're developing, being able to order your furniture and know within a 15 to 30-minute span of time when it will arrive. That's really strong customer relations. And so that's what they're trying to develop. But in doing so, there's an amount of uncertainty as to how to do it. What way will the software work best for best user interface and best results? And that is a second part of the 4-part test. So something new. It's new. It's a way of getting the delivery pinpointed to a span of time never heard before. There's uncertainty as to what will work. And therefore, we're going to have to go through a process of, you could call it trial and error, you can call it experimentation, but we're going to have to go through a process to find out which way the development's going to work best, which is going to be the best way to initiate it. And it's technological in nature, which means it's basically the STEM sciences. It's the physics, math, biology, chemistry, and computer science is included in that. And not included in this is what's known as the soft sciences, which are psychology and sociology and accounting. Okay, yeah. All right, I think you get the idea. We'll see more about this. All right. Uh, so it's expenditures paid or incurred with your trade or business. So you have to be in the business or startup business. And it's not something that's a property or machinery, it's an expenditure. We're going to see more about exactly what these are later on, but for the moment, I just want to get to this part. It's usually all software development costs fit into the category of Section 174, with exceptions, but it's a pretty good assumption. All right, let's skip this lots of language, and if we need to, we'll come back to some of all this language, which is in the Treasury regulation, further defining research and development expenditures, because I've got some slides that will go through what we just talked about. To the four-part test once again. What's the uncertainty test? It's research where, as you can read, it's uncertain how it's going to work, what's it capable of, what's the best way to design it. And by the way, you'll see it again on a slide, but let's say it now so there's no confusion. It is not testing marketing. It's not testing your clients or your customers. What do they want? So that's a no. Marketing tests are not included. It's the design of something, and what might be part of the testing is, does this work better for customers? Does this work better? Does that work better? That might be part of it, but it's going to be more based on what actually will be the methodology or the design of the component. So it's not testing what customers want, it's testing what will work with the customers to get to your ultimate goal. Technological in nature, again, we said it, physical, biological, engineering, computer science. So it applies to a lot of different types of businesses. Notice the word or, it doesn't have to be all encompassing. So that's why, and that's what I've seen in my personal practice. I don't have much of this, which is biological science. We have some engineering, but mostly our clients are in computer science. And that's where we see a lot of research and development expenditures and credits, because it applies. It's got to be doing the following: develop a product or a process, which could be improving the process. It could be improving the product. It could be developing software, improving this software, a formula, improving it, a technique, or improving it, or an invention, or improving it. So it's research not just to develop, but also to improve any of these things, with that element of uncertainty leading to experimentation to find it. All right. Let's see how we're doing here. All right, doesn't look too bad. Research this is a summary of what I think we've been saying: to new or improved business component, product, process. Just take a look at the words with me: technique, formula, invention. That's help or sale, lease or license in the trade or business, including any plant processes, machinery, production technique, or commercial production. So there's a lot. This is a wide open space of things that could apply. And the process of experimentation, which was also part of the four-part test, has to be used to overcome uncertainties inherent to the project. So if you know how you're going to get from A to B, you want to be at B and you know how to get there, that won't fit the bill for research and development. What it has to be is an A that maybe you need a squiggly line to get to B, you're not sure. Maybe you need one of these kind of lines to get to B. You just don't know until you try again. And trial and error is part of an experimentation test. The scientific method is part of an experimentation test, but it doesn't have to be. Simple trial and error can work too. All right. I think we can skip this for now. because again, I don't want to get into the weeds of the Treasury regulations. I want to concentrate on the big picture, and we'll see what we have time for later. All right, exclusions. Let's see what some of the things that do not qualify for research and development expenditures, or what wouldn't qualify at all. So let's get an idea. And there's a bunch of them here. We'll go slowly through the list. Anything that is research after you've commercially produced the new component, the better component, the invention, whatever it is, whatever that research is after commercial production, if it's not for improvement, but you're doing further research about it, that wouldn't apply. I haven't seen that happen too often, but it's very possible. And most likely this would be a marketing issue, I think. All right, making an adaptation of the existing business component to modular or made to order, that's might be considered an improvement, but it's an improvement from the marketing standpoint. If you think about it, persons can buy made to order if they can buy particular parts of a product or a software. And if what you're doing is taking what you developed and putting it into that form, that's not research and development. That's just accommodating the marketplace. I think many of you probably know this concept better than I do today. Reverse engineering of an existing business component that doesn't fit research and development. There might be an element of uncertainty when you're doing it, might be requiring some experimentation, but that's not what the tax law is designed to do. The tax law is designed to initiate original research or improvements. Here's that marketing concept, surveys and studies. Notice also quality control issues don't fall into this. So if you're not developing or improving a product by getting better quality control, you're just improving the production line, so to speak. Now here's a big one which gets people tricked up a bit, and it's called internal use software is not considered research and development. Remember, this is the list of not included in R&D. So internal use software sounds like, well, that's every software I'm using. Okay, or every software I want to develop, that's all internal. Yeah, but if you think about it in terms of the client that I have in the retail furniture business, it's true that this is their warehouse, and they're improving their software in order to attract inventory better. But at the same time, the customers are also going to be using this software, using this developed product that they're coming over. There's developed improvement when the ordering and getting delivery. So that element of involving the customers in that software, these customers are going to be invited in to use the parts of the in-house inventory system, and therefore it's no longer considered internal use only. And now there's going to be research and development credits that will apply. As I mentioned, it's for increasing research and development in the United States, and that's why foreign research is listed there. It doesn't apply. Soft sciences do not apply. And funded research also does not apply. That's if you're being paid to do research and there's a existing uncertainty and you have to experiment to find out what works best. But at the end of the day, the research that you're doing for whatever it is won't be owned by you. That's what's called funded research. So if you're a contractor and what you're doing is you've been contracted out to test or to design and test the design for a particular person who will be using that design, that you're not going to be able to use the R&D credit. You're the person you're selling your services to, they will be able to use it, but not you. That's what funded research means. So it doesn't mean grants that you get to try to do things. It means that you wouldn't own or have the rights to or be using whatever improvement or new process, invention, idea you create. All right. Okay, now we're getting to the final stage of understanding the big broad strokes. There's a lot in the weeds with the regulations and so forth, but we're getting close to having a handle on everything. What costs qualify for the credit? because that's going to drive what the credit will be worth after applying the tax credit rate. Okay, so you've got wages, supplies, cloud computing, and outside contractors. All these areas of expenditures will apply. We're going to add them all up, as long as they are what are known as the QREs. There you go, QRE. These are the QREs. If you get whatever you get in each bucket of QREs, you add them all up and you apply the tax credit rate to that, and that'll be your tax credit. All right, so let's take a look at some of the details here. What are in-house wages QREs? So it's direct research, direct support for the research, the supervision. This could be your your chief cook and bottle washer overseeing the project, whatever it is. So some of that person's time could be allocated towards the cost of research and development, helping increase the credit. The direct support could just be admin people who are putting their time in specifically to support the research people. And then there's what's called a substantially all rule, meaning if you get to 80% of a person's time and a particular wage earner, let's say, they're spending 80% of their time on research, they're spending 80% of their time in this endeavor under qualified research and development activities, which we already covered what they are, then it becomes 100%. The salary becomes 100%. We just bump it to the next level. We put 100% of the salary into the bucket of wages. This one's minor, but just in case you want to know what WOTC, it's the work opportunity tax credit. So if somebody you're paying is getting you a tax credit based on who they are and what they qualify for with that tax credit, then their salary wouldn't apply to you can't double up. That's the basic idea. In tax law, it's rare to be able to double up tax credits into one bucket. So if you qualify for one tax credit, it would be to the exclusion of others. So that's basically what it's saying. All right, so that's wages. Supplies, it's whatever you use in the research, but it doesn't include depreciable to the taxpayer or land. And that sort of makes sense. So it's mostly what we call tangible movable property, but not including computers if they're your computers. So it's basically movable property or items that are going to be used up. And a lot of what applies here that I've seen, where I've seen it, is in developing the pilot or the model, the actual model of like an invention. I saw that once with a client getting the R&D credit, and they had to develop a prototype. And so through the prototype, there's a lot of costs for the supplies and the parts that went into the prototype. Those all qualified. All right. Then we come to what's called computers. And that is, when we looked at that, let's go back. I want to just see. We called it cloud computing. So that seems to signify that the cost of computers, which would not include PCs or mainframes on the business site, would not apply because it's not cloud computing. And that's correct, but let's take a greater dive into it and see what it really amounts to. All right. So computers in the conduct of qualified research. If it's off-site, then that's going to be okay. Now, that doesn't mean you own it, because you can't be the owner of it, but you are using, and this is why today the research and development tax credit, when it comes to software development, is becoming getting exposed more and more in the business world, more and more people finding it's available, because it's not unusual to use cloud computing software where you're actually leasing the software or paying for the software online, so that the computer doing the work is not in your business. So there's a lot of opportunity here, unlike maybe a few years ago with the development of a lot of people in the business world, what do they call that? The software as a service type businesses. A lot of companies are using that. So those costs apply. So that's really basically the concept there, is you're using the software. And when you're using the software of somebody supplying the software, it's their computer you're using. And that cost would apply. Okay, so that's good. So it's not out of the box. Cloud computing, CG, is a very strong possibility of being in your model, in your expenditure box for research and development tax credits. Okay. And then finally, these are for contractors, subcontractors, or as the slide describing the four elements, they called it contractors here. So that's where we're at now, defining what those contractors mean. And it says written agreement, but there's lots of case law that says even an oral agreement is fine. Of course, I have to say this, even though we don't have a established legal relationship here in terms of my advice. It's good to get even an oral contract, as good as it might be under law. It's good to get it in writing. And the general rule is 65% of those contract costs will apply as a qualified research expenditure or research and development cost. However, there's some exceptions, which are nice. If it's under whatever, I don't know what the heck this means because I haven't had it in practice. So I apologize for saying it like that, but I haven't had that. But it would be 75 of whatever qualified research consortia means, and 100% for qualified energy research for certain entities. This is the one I'm familiar with, seeing that the most. But the good news about it is that at least using contractors doesn't put you out of the box. It's not a disincentive to subcontract a lot of the research and development work. All right, we're going to take a look at an example of what a credit would look like after adding up the expenditures and taking into account what the prior years looks like, since we talked about that this is an average. So let's just take a quick look. This is called the alternative simplified credit. There's two ways to do the credit. Their amount, what you do is, by the way, you just choose whichever works better. So I'm going to show you one way, the other way more complicated, but you can use either method, and your tax preparer, your tax accountant would use either way that works best. Here's what it looks like. First, you're going to compute the average prior year qualified research expenditures so that you know what your base is, to see if in this year you increase. So this year, the current year, you want to go over, we'll call it the CRRR, should be greater than the base in order to get a credit. So that's what we're going to be doing in steps 1 and 2. The average is step 1, is then you multiply times that 50% in order to get that base period. Then you take a look at the difference between the current year and the base year, or the base calculation. And then whatever that number is, as long as that's a positive number, you will multiply the percentage applicable to you. There are various percentages based on the amount of dollars involved. It goes to a high of 20%, and it doesn't stay in the low range too far. So you're looking at probably 9 to 20% on 9% is a minimum. And so it's not so bad if the credit turns out to be okay. Let's take a look at an example with real numbers, and you'll see that you get to the 14% rate pretty easily without a whole lot of dollars and cents worried about. So you got average QREs in the prior 3 years. We're going to do a 2023 example here. And we take the average of the prior 3 years. And this could be, I'm not saying it is, but it could be the numbers from my furniture client, which is not going to amount to a huge amount. So just add a 0 or 2. Okay. And you get to an average of this number. You multiply this times 50%, and you can see your base is now not terrible because it's half of what the average was. Current year, $10,000. We add up all the current year QREs, subtract it from the base year, we get this, apply the rate 14%, and the credit is this number, about $1,000. So add 2 zeros to that, and you can see that it's a very worthwhile venture to go into, to take a look at when you have the applicability to reduce taxes that way. And finally, states have their own tax credit program, which really just adds to the fuel for wanting to do this. In Maryland, it's 10%. In some other states, it's very similar. Many other states have a 10%. I'm not aware of any state having much larger than 10%, but it's possible. And of course, what it does is it attracts research and development activity to that state, which is very economically sound for states to try to do that. And so Maryland's got one, and it just sweetens the pot, because then if you go back here and if you put 14% on the federal side and add another 10%, okay, now you're talking 24% tax credit, and you got my interest. Now, from the standpoint of what you can do with this credit, besides helping yourself with your payroll costs, if you're a payroll intensive startup company, as we saw, there is a tax credit, there's a research and develop tax credit where you don't have to use it against taxable income, because you may not have taxable income. You can use it against the payroll taxes. What are payroll taxes? Just very briefly, payroll taxes are Social Security and Medicare. Every employer pays, on each dollar that they pay an employee, 7.65% for those taxes, 7.65%. So imagine a fairly large payroll for developing a product that's labor intensive with engineers, and all of a sudden you've got a lot of payroll taxes. And if you can reduce that if you can reduce that to zero, which if you're getting a $500,000 research and development tax credit, you use that against all the payroll taxes potentially, if it's that amount. That's a huge incentive to make sure you don't miss taking these credits. And of course, that carries forward. If you elect to do it that way, it carries forward to future payroll. If you don't elect that to use it against payroll taxes and you're just going to use it against income taxes, that carries forward for 20 years. So you got a huge window of opportunity to use these credits to reduce either the payroll tax or income taxes themselves. And thus, people should have some incentive to go into research and development type activity, or to at least look at it with whichever they're doing to see if it applies to them. From an investor standpoint, investors, generally speaking, are going to be what are known as passive investors. They're not going to be involved in the management of your company. If they are not involved in the management, there's only so much they can use of pass-through entity advantages. Pass-through entity advantages, remember, it's not a tax-paying entity. So what happens is, let's take a look at let me do a slide for that. I'll wrap this up in a minute, but let's do a slide for that to make it just so much a little bit easier to see what we're talking about here. Okay, so we've got, oops, there we go. So here we go. So just, if it's a pass-through entity, which is called PTE, what happens is that you have owners, and these owners are basically you. And then you've got investors who are not going to be involved in management. They might, but they are generally either they don't want to be involved in management, or you don't want them to be. So you tell them you'll be a passive investor. You'll be like a silent partner, we used to call it. So these passive investors, they can put money in. You put money in, and they put more money in. That's your startup. That's how you fund yourself. And the windup would be that if there are losses, in the concept of a pass-through entity, those losses, since it's not a tax-paying entity, they pass through to the people who are the owners, the investors, even the passive investors. Well, the passive investors can't make much use of those passive losses, as they'll be called, but they can use it against passive income. So there is still an advantage, and there is still an attraction to investors who have passive income, because those losses will reduce their passive income and reduce the amount of tax they have to pay. Likewise, if they have passive income, if they have this, they can use the credits. So the outside investors that you're going to attract would be people who have passive income, where they're going to be able to utilize the credit, where they're going to be able to utilize any opening years of losses that you might have. And therefore, the research and development tax credit, along with some of those startup losses that you might be projecting, are going to be of interest to an investor. Now, of course, what they're going to be looking at is what is it that you're doing? What's the likelihood of it's being successful? Why would you, of all people, be successful doing what you're proposing to do? They're going to do all that kind of due diligence. But having the concept of knowing that you can say to them, we're going to be eligible for a research and development tax credit. We've had a initial due diligence study done, and there are accounting firms that specialize in this. We've had and they hire engineers to help with it, to identify research activities that apply. And what they've done is they've studied what we're going to be doing, and they're projecting our research and development tax credit will be. And they give you a number. And the investors are interested in that because if they have passive income, then it's a way for them to offset the taxes from that passive income. There's numerous institutional investors out there that are investing in passive activities, meaning they're passive investors. So those institutional investors, quote unquote, would be interested in talking to you about perhaps helping to fund your business. Of course, as I just said, it's going to depend on what you're proposing to do, how likely it is for success, and how much trust they got in your capability to do so. But this is an additional way to attract that type of investment. And plus for you, it's also like, even if you don't go outside investors, you develop yourself, this is a way of sheltering future income or payroll taxes. So it's not bad. It's complex, and you would definitely need a fairly sophisticated tax accountant to work with you on it. And perhaps they'll hire some outside people, like I said, like engineers, to help determine what falls into the right buckets for what you're going to be doing. But it's going to be well worth the dollars and cents if it applies to you. All right. There we go, Ala. We can now see if there's any questions.
Thank you so much, Sam. So we have a question from Anthony. Anthony, thank you so much for your very kind words and for the question. So Anthony says, thanks again, Sam, for this great panel. Took lots of notes, and it looks like we're going to have a nice tax credit from Uncle Sam that we can use. Fantastic. My R&D costs are primarily from supplies and contractors, and it looks like my physical product fits the criteria for the credit as well. Is it possible to finance this tax credit to investors for capital, or can I only use it?
So I think what he means is, can he sell the credit up front to get, like, let's say the credit's $1, can he sell it for 90 cents on the dollar? That I'd have to find out. I'd have to check with some of the financial institutions that do invest in tax research and development tax credit entities to see if that's the case. I know of it in other credit areas. I haven't just had that experience yet, but it's possible.
Thank you. That is a good question. I don't see any other questions. If anybody has a question and you would like to either type it up, or you can also raise your hand at this point. I can unmute your mic if you would like. And if not, just reminding everyone that we will be posting this on our Startup UMD YouTube channel. So if you would like to review, I know it's a lot of very important, very detailed information that Sam, you provided us with. So if anybody would like to review that, you can watch it on our Startup UMD YouTube channel as many times as you would like to. And then shoot me an email to see if you have any other questions that you can't think of right now, and I'll forward them to Sam. And as I said, stay tuned for the live session that we will do, live Q&A session sometime in January.
Right. And that'll be at the beginning of the tax preparation season. So just right for if you've got a startup business, or if you've got, or you're thinking of a startup business, or even if you have a sort of a mature business, 2-5 years out, or even if it's as much as it could be. I don't think we'll have a limit on it. So it could be a lot of business questions that you might have. And we hope to work this out is where I'll be available one-on-one in some type of workshop format over like a 1 or 2 hour period. We'll work it out, Ala.
All right. Thank you so much. Thank you, Sam, and thank you to everyone who attended and stayed until the end. And look forward to connecting soon again. Thank you so much,
All
Sam.
the best. All the
Thanks.
best.